The U.S. Federal Reserve is prepared to reduce its balance sheets made up of massive bond holdings purchased during the last recession. However, in regards to the timing of its next rate hike, several officials were hesitant to pull the trigger due to low inflation, which remains below the Fed's target goal. Joonhee reports.
There is a strong consensus among Fed officials to scale down the bank's asset portfolio, now sitting at a staggering $4.5 trillion, built up through 3 rounds of quantitative easing. Minutes from the central bank's July meeting indicate measures to scale down the Fed's balance sheet could be announced at its September policy meeting, with the roll-off to begin soon after. However, board members remain split on the timing of future rate hikes, with some officials wary of low inflation, which remains below the Fed's 2% target. While some remain optimistic that price growth will eventually reach its target, others say the Fed must exercise patience under the current circumstances. The central bank's preferred measure of inflation dropped to 1.5% in June, compared to 1.8% in March, raising doubts on the wisdom of raising rates in the immediate time frame. Overall, the FOMC members' prognosis of the U.S. economy was mostly healthy, especially in its labor market and household spending. However, the minutes cited weak retail sales and sluggish wage growth as factors of concern moving forward. Fed officials are also expecting little help from President Trump's fiscal drive, with Washington's tax reform and infrastructure plans still stuck in limbo for the time being. The Fed's upcoming rate hike, whether or not it occurs before the year is up, may also put the Bank of Korea in a very tight spot. Despite surging exports, some experts say it's a one-off phenomenon due to high semiconductor demand, and that another rate cut, in addition to the government's supplementary budget, is necessary to keep economic growth on track. Joonhee, Arirang News.